We're excited. We'll let people trickle in the next couple minutes. Typically, our workshops are about 25 minutes, a 30-minute presentation, followed by a 15 to 20-minute interactive Q&A session. Kevin O'Donnell is the speaker today. Quite impressive. He worked at Microsoft during the early days, starting back in 2002. He was the head of translation systems. He worked at Nitro. He's the VP product at Nitro, also the VP of international growth at Dropbox. This workshop is going to be focused on go-to-market strategy, specifically moving into international markets. But Kevin, if you can give a background and introduction of yourself, and we can hop right into your presentation, that'd be fantastic.
Yeah, thanks, Tega. Hi, everybody. Really nice to be here with you all. So I won't go through my background in great detail. 20-something years in tech. Covered a couple of things in my background. I started as an engineer, moved into product management, product leadership, and then into international growth between marketing and localization. And I realized that the heart of all of that was really go to market. It's around figuring out how you can take a product, a solution to a problem, and put it in front of customers in the right way. So for the past year, I've been working independently, and my focus is helping early stage startups with their go-to-market strategy and figuring out the most efficient way to take their product to market and get in front of customers. I also help slightly later stage companies with their international expansion and revenue growth internationally. I love the variety, love working with startups that are trying to solve this problem. And I do give a workshop in go-to-market. So the slides today are from the workshop. It's cut down. It's hard to cover this in 25 minutes, but so it's going to be a very, very abbreviated version. Happy to share the slides later. Would really welcome Q&A and discussion at the end of this.
Awesome. Well, Kevin, we're excited for this. If you want to hop right into the presentation, we'll go into that and then follow that by Q&A. So everybody on the call, if you have any good questions, feel free to write them down and we'll go through them here in about a half an hour.
Okay, terrific. So today we're going to talk about building sustainable go-to-market strategy, and we'll cover customer acquisition right up to long-term retention very, very briefly. So I don't assume I could talk about all the elements of go-to-market in just a half hour. You could spend a day or several days going through this, but I'll try to cover the basics and then we'll see where the discussion takes us. You may have seen this.
Sorry to cut it really quick to it. So like, as for everyone here, as Kevin mentioned, right, we'll save that. We'll have some Q&A at the very end. But if you have any questions throughout, feel free to drop it in the chat. That way we can help kind of filter and admin it throughout the end. And then, right, the goal will be whether it's, again, a product-focused business, agency, consultancy, feel free to compile all those types of questions there. And then we'll make sure we can get them addressed throughout the presentation. So sorry for that, Kevin, and appreciate it.
Yeah, absolutely. Thanks, Brian. Okay, this is one of my favorite quotes. You may have come across it before from Justin Kan, and it's the idea that most first-time founders put all of their effort into the product. The product is their passion. It's what they're most focused on. It's why they're what drives them. But then second-time founders realize that actually what matters, what gets them over the line, what brings the customers in is distribution. And distribution really means go to market, because you can have the best product on the market, the most innovation, differentiated features, but if you don't know how to put it in front of your customers, you're not going to win. And my time at Microsoft are probably the kings at distribution. They learned that with their product suite, their product strategy, their partner strategy, and distribution really paid off for them. I feel it pays off for everybody else. There was a really interesting write-up from Alex Schubert. He's a VC a couple of weeks ago, and he was talking about the startups they didn't fund and why they didn't fund them. And I thought this was really interesting. The way he phrased it was that every time he doesn't invest in a startup, he's disappointed. A VC is looking to find a startup that ticks all the boxes, that is going to win. But it was interesting to see what are the common reasons why they don't. And if you look here, the top 3 reasons: differentiator, opportunity size, commercialization risk. So over 2/3 of the reasons are really all around go-to-market. And that really highlights how important it is to focus on your go-to-market strategy, to keep refining it, adapting it. It's never static. You're never going to find one go-to-market that will work at every stage of your company. It's constantly evolving, and in terms of competitive risk, in terms of where your customers are at, in terms of the product capabilities, probably every 6 to 12 months, you need to change and evolve that go-to-market strategy. And this just highlights that if you're looking for funding at some stage or looking to grow your company, it's going to be one of the first things people will look for. Now, most startups or early stage companies, they're all around solving a problem for their customer. They're all around, we're going to make your life better in some way. And I think it's useful to know that from your customer's perspective, is the problem you're solving in one of two categories? Is it an essential problem? As far as they're concerned, everybody in the call here, we all think what we're doing is essential and very important. But from the customer's point of view, do they view the problem as essential? And if it is, they probably have an urgent need. They probably have a defined budget, and they have money allocated to spend on this. They might already be spending money on something similar, and they're going to be very motivated to buy it. So you will get their attention much easier if what you're bringing to them is essential. They must have it to conduct their business. However, if you're a nice to have product, they might love what you do, but you'll be considered important, but probably not urgent. And this is very important because arguably 80%, I would say, of startups fall into the nice to have bucket. It's not a problem, but it is very important to understand what category you're in and how your target customer will perceive you. Because if you're important but not urgent, it is easy for them to delay the decision on buying your product or your service. And if they can delay that decision, that is a lot of uncertainty for you. And it means you must have a much larger pipeline. You need to work that much harder to drive their motivation. They may not have budget. I've been working recently with a startup in the energy sector, and they sell to very large companies, and they were selling to one in Spain. They spent about 6 to 8 weeks on a pilot. Everybody in the energy company loved this startup and their innovative solution. But then when it came to it, they said, oh yeah, well, we've spent all of our budget for this year. Can you come back to us in 12 months' time? And this was catastrophic for the startup. They didn't realize, they had forgotten to check, or they didn't think to check, is there budget available for this? And that can really delay things if you don't qualify that early. If you're a nice to have, you will probably need to rely on champions in your customer, and people who will support you, help you get over the line, and help drive that decision to yes. So let's talk about your ideal customer. Now, I'm sure you all have an ideal customer and you've refined it over time. And I would say, how well do you know your ideal customer? You need to know them inside out in order to devise a go-to-market strategy that's going to be perfect for them. So do you know their industry, their company size, their particular role? Do you know what their pain points are and challenges? How motivated are they? And how would they articulate the success of taking your product or of solving this solution? And their articulation is often very different to how you might talk about the benefits of your product or your service, but it's their articulation that matters more than anything. Their buying process, it's really key to understand, how do they buy other software, other products, other services? Because you will most likely have to snap to their buying process. Do they have a particular way of paying? Do they expect a trial? Do they expect add-on services? Do they need to get layers of approval? If you know that, you can then arrange your motions to match that. We talked about budget. Really important to know, do they have the budget? And they might be interested, but if they don't have a specific money allocated for this, then you're going to be delayed. A very common mistake is to conflate your ideal customer profile with the decision maker or the buyer and the person who's actually going to sign that check, sign that invoice. And if your ideal customer is not the same as the decision maker, it's maybe their boss or the head of procurement or somebody else in their organization, you need to loop them in. You need to make sure that they're part of it early so that you don't have to reset your buying cycle. And then your ideal customer, can you reach them? I've seen so many startups where they have a very clear view of who their customer is, but they are hard to access because there's some barrier in the way. It might be because you need to network with them, or It's maybe a closed industry. So understanding the accessibility and figuring out your route to your customer is key here. Now, the other thing I would say is, while you might have an ideal customer profile, sometimes you need to start with a subset of that, a first customer profile. And this can be really helpful to break down your ideal customer profile to something more tangible and attainable. So it could be a more accessible segment where you can focus on validation, you can focus on getting product market fit, you can move fast. They will hopefully have a more urgent need where they can make a decision quickly and they are more prepared to buy what you're selling. They're not going to wait months or years to do that. Now, in contrast, you will still look towards your ideal customer profile, but this might be something you graduate towards. And it's likely in a higher value segment when you're ready to scale your revenue and your growth, and you've proven your model, you've proven the go-to-market motions that work for you. In this case, there will be clear defined needs and a more systematic way to buy your product or your service, but that takes time to develop. And often companies get stuck on trying to perfect things for their ideal customer when it will be far better, and you can learn so much more if you look for your first customer profile, start there, get some wins, get some testimonials, case studies, iterate through your product a little bit, and then move on. Now, a nice way to think.
And I had a kind of question as well, kind of chiming in on that before I forget at the end, is a lot of times, whether it's a service-based startup to your point or product-based startups, we talk about the wrong customers, right? The customers that it's tough to say no when you're in an early stage, but you end up taking scope of work that don't necessarily align with your initial thesis, or you're building features that maybe didn't align with your original roadmap. So I guess, how do you, as early stage founders, how do you know when to say no, right? Or if it's worth it, right? Because again, if you only have 3 customers and you want to get a fourth, more often than not, you're going to kind of appease them or build things that kind of go to that. But when is the time to say no if it doesn't align with your customer thesis?
Yeah, it's a really good question. Answer that on the next slide to illustrate the point. But the way I would think about it is that your first customer profile should really resemble a beachhead strategy. And so these would be first customer where you're looking at a more focused version of your ideal customer. You're thinking about niche and immediate needs, and what this customer needs from you should be reflected in what you can build or deliver today. It is not what you can do in 6 months' time, 12 months' time. So your first customer is unlikely to be an enterprise that needs two-factor authentication, needs certification and ISO standards. That's not ever going to be a first customer for most people. Your first customer is somebody who can make a decision quickly. Now, if that same first customer wants you to develop something in order for you to retain them, you have to decide, what is your next step going to be? What would your adjacent customer be? And if this same customer aligns with that, they're going to naturally lead you towards that. Then I think it's perfectly fine to develop that next feature or develop something that's going to keep that customer. If there is no likelihood of that customer resembling many others and their needs are not going to resemble many others, then the danger is you'll paint yourself into a corner and you'll end up more like a solution integrator delivering something for that one customer. So I would say you need to have a product strategy that is clear and mapped out to the customers you want to serve. And that might mean saying no to some customers or saying, well, we can do some of what you want, but other things just don't align with what we're building. And that's difficult to say no if it means missing out on revenue. But if it's not feasibly going to open the door to more customers, it will just delay you in the long run. So keeping an eye on who is your first customer, what can you do to serve them, who would be the adjacent customer after that, and then finally, how does that lead you to your ideal customer? To give an example of this, there's a med tech company I've been working in recently, and they started out with their ideal customer being large hospitals. Now, large hospitals are very, very difficult to sell into. They have slow procurement cycles. They expect very high certification, trust standards. They will not just trust a small startup with introducing software to a hospital. So realizing that that's not attainable for them, They started out their first customer being individual medical practitioners, sole practitioners who work independently in an office, and they had a medical record software they were selling to them. It's a much more attainable, immediate need, lower risk, lower barriers to entry. For their adjacent customer, their plan is then to move to mid-sized clinics. So clinics where there might be between 5 and say 30 medical practitioners working there. That will be a step above that. And also it's a stepping stone towards getting to that hospital ideal customer in the future. So it's a very logical transition, and it can be a useful strategy for when you're thinking about, where is your company going? How do you go from starting out with one customer to the next? And ideally, they should build on each other. If this was an interactive workshop, we spent a little bit of time on this. We won't do it today, but you might want to do it in your own time. It's an interesting template to see how easy is it for you to fill in the blanks here on this ICP writing template. And ideally, you can just do it off the top of your head like that. If you can't fill this out very easily, then potentially your ideal customer needs some refinement, or it's a little bit too complicated. I would just think through this. It's a good reminder to see how simple can we make our ideal customer profile. It's a good reminder for everybody. Okay, let's talk about go-to-market models. And I'm going to very, very briefly run through 3 of the main go-to-market models here and some of what sets them apart. So we're going to start with product-led growth. And for product-led growth, you can think about Dropbox, Slack, Zoom, products where it's the product that drives its own acquisition, retention, and expansion. So the product has to sell itself. There must be very, very fast time to value. So within minutes or hours, a user needs to understand and perceive the value they get from that. It's usually perfect for SMBs, individuals, or teams. And typically it's when the price point is relatively low, maybe up to 25K. I've seen people put onto a credit card, but above that, it's unlikely to be workable. The growth strategies here are around growth loops built into your product. So think about a viral product, network effects, having a freemium conversion flow where when they use more of the product, they want to buy more of it to get more value from it. Now, the next one I'll talk about is the classic sales-led growth, where it's a sales team driving the acquisition and relationship building. It takes longer, but that implies you have a more complex product or a product that might require explaining, onboarding, training, configuration. So you need to have a conversation with somebody in order to explain it and help them see the value of it. So it's more suited to mid-market or enterprise. There are exceptions. Sales-led growth can be ideal for individuals if you have a very unique product or very high ticket price product, but typically this will be more mid-market or enterprise. And in terms of driving growth, you need to focus on pipeline and velocity. So how fast can you close a deal, and how robust is your pipeline generation activities? The third motion I want to talk about briefly is partner-led growth. It's quite close to sales-led growth, but it's where you're effectively outsourcing some of your sales to a reseller, a distributor. This can be a great way to scale, or not ready to hire a sales team, or in certain markets or geographies, you don't want to have people in market or it's too expensive to do that. You can leverage the connections and knowledge of a local partner to do that for you. A lot of companies will do this when they're selling internationally. They might leverage a partner in Japan, for example, who will help them enter the market and take advantage of the local selling nuances and marketing opportunities there. I would say with partnerships, it can be quite slow to sell. They often will need implementation support. You're obviously sharing some margin with a partner. So there are the downsides. The upside is that for proving out value and for distribution, it can be really ideal. So there are 3 pretty common approaches to go to market. I will say they're not mutually exclusive. So many companies will have one primary mode and then will extend into a second or a third over time. It's usually good to pick one that fits your product best and then expand beyond that. So let's talk about where can you find your customers. And I'm going to very, very briefly cover a couple of the different channels and how you would think about it. And then we'll talk through that. Some of nothing here is rocket science or is probably unknown to you. So I'll just briefly review the online digital space where you have your own property, site, blog, email, etc., Google ads, social media ads, or earned through SEO, PR, social media reviews, and so on. Direct sales, we just talked about, outbound, inbound, cold outreach, using product-led growth. Community and influencer, so using your friends, your network, building a community among your likely target customer, using influencers, word of mouth, or referrals. Think about partnerships, so resellers. We talked about strategic alliances that could be with consultants, it could be with individuals, with other companies who might operate in an adjacent space as you, so they would have a similar customer as yours, but for a different category. That can be an amazing alliance. It could be really mutually beneficial if you pursue that. Or affiliate marketing, where people earn commission by referring customers to you. And then events on offline. So think about relevant conferences, trade shows, webinars, and so on. Now, a point I would make is it is usually best for early to mid-stage companies to pick 2, maybe 3 of these at the most. Where I see a lot of startups go wrong is they try to do a little bit of everything. They sprinkle their attention into some Google ads, some cold outreach emails, some word of mouth, some affiliate marketing. They show up at a couple of trade shows, and they will often say, well, nothing seems to really work. We try a little bit of everything. And it's probably because their attention is so diffuse. So I would always recommend identify where your customers are likely to exist. If you don't know, look at what your competitors are doing. It doesn't mean it's correct, but it will give you a clue. If your competitors heavily leverage conferences and trade shows, they've probably learned that that's where your customers show up, and they might expect the players in the industry to be there. If you're selling an online product, maybe influencers are best for that. So figuring out where you're likely to interact with your customers is a good starting point. And then be deliberate about how you spend your time. I often recommend treat this as an experiment. So decide, I'm going to do Google ads or LinkedIn ads, but I'll do it for a month. I'll put a certain budget behind it. I will test it out, and I will have a hypothesis about what this will do for my lead generation or my brand awareness. At the end of that, if it hasn't worked out, I will either pivot or I will move to a different channel. But making a clear decision as to whether it does or does not work for you will guide you towards a channel that definitely does work. So I think finding the right angle for your business, for your product, and for your customer is key here. Sometimes it will depend what your skill set is. I know somebody who's an excellent content writer, and he's built his entire business on SEO. It's a product-led growth business, but he doesn't do any advertising, doesn't do any partnerships, webinars, trade shows. He does everything on SEO because he's very, very good at that. He knows he's good at that, and that scaled well for him. So it's finding what works for you and what works for your customers is key here. I'll briefly talk through some of the common pitfalls. I recently did a review of about 20 startups on the go-to-market strategy, and this is a summation of the key downfalls that a lot of them had, or the key danger points a lot of them had. I've just been talking about lack of focus and fragmentation. So it's trying to do too many things at once will really delay your go-to-market. So get good at one thing, execute it well, repeat it, find what scales and do that. I always think the best go-to-market strategy is the one that works without your attention. So ideally, there's a go-to-market strategy that can work while you're on vacation or while you're on your weekend. And that's the one you want to focus on. Best startups can scale beyond their founder. So the founder will get them so far, but then you will become a bottleneck. And you want to find what is the go-to-market strategy that will help you scale your effort and go beyond that. And you need to focus for that. First mile barriers is a very common pitfall for go-to-market. And it's related to the ideal customer issue we talked about earlier, where you might be trying to penetrate a regulated industry, or you might be trying to get into a customer space that doesn't really talk to individual startups. They need a partner, or they need a contact, or they need an introduction. So the first mile barrier is where you can put a lot of effort, but you're knocking on a door and nobody's listening. So that's an indicator that you need to look for your first customer profile, or you need to explore partnerships or warm introductions to get past that barrier. But if it is very, very difficult to make that initial connection, then you need to go an alternate route. Not understanding the sales cycle or underestimating what it takes is so common. If you don't know whether there will be budget, if you don't know what is required for your customer in order to buy your product, then that's going to be your downfall. So for your customer, do they need approvals? Do they need their security team to look at what you have? Do they need a certain level of privacy guarantees from you? So not qualifying your customer and understanding what they need, that can really hold you back. And this is all around understanding their context, understanding how they work as early as possible, and that will avoid the barriers late in your sales cycle. And we're going to talk about ROI in more detail in a moment, but if your ROI is vague and unclear, then it will be very hard for your customer to decide to purchase your product or your service, or it'll be very hard for them to renew it later. There is another startup I worked with recently. They were sort of developing AI software that would help with customized learning paths. So it's quite an interesting solution, but their ROI they promised was that we are going to help your company grow revenue faster. And my reaction to them was that nobody's going to believe that. And even if the company revenue does grow faster next year, nobody's going to connect that to your software, because improving an individual skill set through better tailored learning paths is a good thing to do, but it's a really big stretch to think that's going to grow company revenue. So they had completely the wrong ROI. It was orders of magnitude out of what it should be. And so for them, they had to tailor and narrow down to figure out what problem are we solving and how do we demonstrate that. So understanding the ROI that your customers care about and can articulate is what matters here. And if your product or service requires your customer to change their habit, you need to put a lot of effort into making sure they are prepared to do that, because we all know habits are very hard to change. And if your customer is not at the right time or is not suitably motivated to change their habit, then they might buy your product or your service, but it might not stick. And then you won't the renewal that you need, or they might not buy it again, depending on what it is. So figuring out if it does require a habit change, are you set up with the onboarding and the training and the customer success and the post-sale support that are needed to make sure that habit does happen, that habit change happens, other people on their team are bought into it as well. Finally, to ask the question earlier about developing a product feature that might be wanted by one of your customers, but not more. That's an example of something that doesn't scale well. I think early in your stage of a startup, doing things that don't scale is wonderful. It's a great way to learn and to figure out, if you want to give white glove treatment to your customers, I think that's the great thing to do. But at some point when you're ready to scale and to open the floodgates, you need to make sure that every element of your go-to-market will scale. And if there's elements that are stuck, elements that simply need too much hand-holding, you're going to run into a barrier. So if your product needs you to be on every call to onboard a customer, but it's only a $100 service or product, that does not scale. Figuring out ways to scale without you and ways your product and go-to-market can scale will really unlock growth here. Okay, we're going to briefly talk about ROI. It's one of my favorite topics. I think it's pivotal to the success of any product and service. And I always think ROI is not what you say it is. It's what your customer articulates it to be. And so whenever I work with a startup, I say, tell me about your customer's ROI, but tell me how your customer perceives it. And for some people, it throws them off a little bit because they understand how they talk about the benefits of their products and how great it is and how much it does. But if that's not how your customer will articulate it, then it doesn't really matter. They need to be able to explain how simple it is, how it's quantifiable, and how it's immediate. So can they see the ROI within a day, within a week, within a month? If it's delayed gratification beyond that, it needs to be substantial. They need to really see the promise of that. It must solve their problem, and it must reflect back to the problem you promised you would solve to begin with. If you can do this, you're going to not have any worries about retention. If your customer sees the ROI and can recognize it and appreciate it, then retention is fine. If they cannot, then retention will be a huge struggle for you forever. Better ROI means reuse, repeat purchase, expansion. Everything comes down to how good is the ROI and how easy is it for your customer to recognize it. There's a company I worked with last week, and they had a really nice product. It was effectively, I'm underselling it here, but it was like a spam filter for comments. So it was a way to help influencers weed out negative, destructive comments. Really nice thing to do. But when it worked well, it was an invisible product. They never noticed it. And so the difficulty there was, how do you describe the ROI to a customer when they don't see a product working? Because we all generally don't notice our spam filter if it works correctly. So it's a challenging situation for them, even though it's a high value product. So making sure your customer can see and articulate the ROI is key. Okay, we're going to finish with a couple of success metrics. I could have looked at dozens of metrics here. I just focused on 3 that are fairly universal, and one is that I would say you always must pay attention to these. First one, customer acquisition cost. So this will be a measure of your go-to-market efficiency. So how effective and efficient is your go-to-market? What does it take for you to acquire a single customer? It helps you optimize for profitability, because your long-term customer value or lifetime customer value should be at least 3 times your customer acquisition cost, at least eventually, maybe not initially. It will help you measure different channels. We talked earlier about all the different channels you might pursue. So I would put a measure on each of them as to the customer acquisition cost. Some of them will be far more efficient, and they're the ones you want to put more money behind. If you can grow with lower customer acquisition costs, it will help you move to new markets. It will help you go broader much, much faster. So the next one, obviously, is lifetime value. And this is really key, particularly for investors or for understanding your long-term growth. It will give you different levers for driving growth. So it's either the order value size, the frequency of purchase or subscription, or the customer lifespan. So any of these you can focus on improving in order to grow your lifetime value. It helps you put focus on loyalty and retention. And that's why I think one of the advantages in an early stage company is you can give all your customers this white glove treatment, give them a concierge level treatment, because you might not have a lot of customers. You can go above and beyond. And so your customers become loyal. They will hopefully give reviews, testimonials, referrals for you. You can put that early investment into building strong lifetime value that will hopefully continue beyond that. Last one I want to talk about is more of a SaaS revenue, but it's one of my favorites. So net recurring revenue. It's a demonstration of how effective and how much will your revenue grow without acquiring new customers. And so if it is over 100% NRR, it implies that the value of your existing customer base is growing simply by them using your product and maybe onboarding more seats or upgrading to a different tier within your product base. It's a really nice measure because it shows the effectiveness of your customer success and the effectiveness of growing your product and delivering new value in your product. It also shows that if NRR is declining, it's a warning that something's going wrong here. So your customer might be contracting how many seats they're using or using your product less. And that's a good early warning system that you need to do something different about this. When this is positive, it's a really great stable cash flow because it obviously gives a lot more cash that you can develop. You can push back into building the business, acquiring new customers, or into developing the product further. Okay. And with that, that's all I have for today. Very happy to connect on LinkedIn. That's my LinkedIn there. I'd love to connect and chat with anybody one-to-one if you would like. Otherwise, I think we've got some time for Q&A.
Amazing. Thank you, Kevin. And yeah, anyone, so we'll start off. We have a question in the chat from Marco, and then anyone else who's got questions, feel free. You can either just unmute yourselves and ask or type it out. So the question, Kevin, from Marco, and then Marco, feel free to chime in if I don't fully highlight it here. But so essentially in the current world where AI agents can essentially be the sales guy, sales engineer for a lot of what we sell service-wise, product-wise, have you seen cases where that is a viable option compared to your traditional sales team because it's a fraction of the cost compared to hiring professionals or these 24/7 type agents? have you seen that play a role in how go-to-market and sales has gone?
Can I maybe just add some color on the question? Hi,
Please.
Kevin.
Hey, Marco.
Really just trying to obviously better frame my business, because essentially that's my business. So when you have in this world where, I'm coming from financial services, regulated, enterprise, big personalities kind of things, right? Big contracts. And I see that lots of folks are saying, okay, we need a paradigm shift. We are moving to audio. People want to describe what they want, and pretty much expect that the consumerization of finance is becoming evident as well at the enterprise level. So all these AI agents today can do exactly the work of any sales guy and any sales engineer out there. So obviously we work on the solution for finance, but I see across pretty much all the verticals this kind of push towards one front end where essentially solving the problem for you for free, PLG wise, kind of a PLG really on steroids in a way, because the contract is much bigger. But it's really like reducing the time of founders, first employees to do the actual sales process, which is slow, and you have one shot. You talk to that person, say, hey, I have this. No, I don't like it. Fine. Today I had a bad day. Sorry. I'll come next year. Versus like, I give it for free 24/7, play around. You can build amazing stuff. You just need to talk to the machine and building for you. So I'm trying to see if you see, I see it my vertical, but I'm wondering if it becomes mainstream around, regulated or super vertical plays, or it's too early, maybe. I don't know.
Yeah, it's an interesting question. So I'll give you my opinion on it. I don't think it's a binary answer. I don't think it's either it works or it doesn't work. I would be much more nuanced with using an AI agent for some role in the sales process. So I would break it down into 20 different stages of your sales process. So go very micro in terms of all the different stages that you have, and decide which of these are the highest value where you want a human in the loop there. So which is the part of the sales that you will say, I need to be there to close the deal, or I need to be there to introduce it, have that human contact, and make sure that somebody knows there's a real person behind the business and I can connect with them. So I would prioritize and identify across your entire sales flow or process flow, which are the ones that are non-negotiable. Human high value matters most. Then at the lower end, there's probably a couple of stages, more like prospecting, reaching out, driving early interest, that are a good fit for AI agents. Think about cold outreach, think about simple repetitive conversations, possibly onboarding calls, configuration, customization calls. I think they're well suited, particularly if they're routine and they can be effectively scripted because they all follow a same pattern. I think that's reasonable. I would say, though, it's hard to generalize, because in every industry, you need to decide, are your target customers comfortable with this? And depending on how your competitors are selling or how they typically buy a solution, are they comfortable talking to an AI agent? And I think they might be comfortable if it's a chatbot and if they're asking simple questions about your product. If it's audio interaction, it depends. I think some of them will not be comfortable. Some of them might be okay if it's more question answer about functionality or about implementation. I would say look across your entire flow, decide which of them are reserved for human interaction because they're essential and that's where your value comes in. And then which of them can you scale better with AI? And that should be the whole purpose. So if you can go, well, I can do, 25 calls with a human, I could do, 500 calls, 1,000 calls with an AI, then that's a reasonable thing to scale if it's going to drive the results you need. I would look at the different stages that in your funnel and decide where it can and cannot play a role.
Perfect. Thank you, Kevin. And Cameron, we have a question for him as well. So Cameron, feel free to, if you want to ask it, on microphone. That way I won't butcher the question for the chat.
Sure, thanks. Yeah, so I was just asking, based on the everything you just presented, would you revise any of these messages or caveat any of them for very small consulting firms where the product is subject matter expertise?
Good question. So, I mean, that's the position I'm in. So I kind of sell my own services for what I do. And I would say the focus is not hugely different. I think the challenge if you're selling subject matter expertise is that scalability is a challenge because it's one person or a very small number of people, and your product itself doesn't scale typically because it's your time at the end of the day. So I would say getting clarity on your either first or ideal customer or first adjacent ideal customer is key. Avoiding wasting time on customers that are not ready to buy is essential and probably more important, because wasting your time is lack of revenue. That's key. I would also probably double down on the element of where to find your customers. Now, I think this is a lot of trial and error when you're selling expertise, is finding who is actually your customer and prepared to pay and have budget, and where can you find them. Again, it's down to your time is so limited. So I would probably put more of an emphasis on partnerships, affiliates, resellers, people who can do the work on your behalf. That becomes almost more important than for a subject matter expertise, I would say.
Thank you.
Great. Thank you for that. And then Yukta, you want to ask your question right now on the chat or via the meeting?
I hope I'm audible.
Yes, you're good.
Thank you, Kevin. I'd just like to understand more about, since you talked about multiple ways to generate leads. Initially, for a small business or maybe a consulting firm or an agency, what is the easiest and most reliable way to have recurrent leads? Would you recommend a customized process to have that influx? Or basically to understand that what should be the ideal method to reduce churn in leads?
Okay, good question. I'll deal with the second one first. So how to reduce churn in leads. If you have churn in your leads, it is usually because you have the wrong people showing up. And when they show up and they go through maybe the first or second stage of learning more about what you're selling, and then they churn out, it's either your messaging is wrong, or more likely they were a bad fit for what you're selling. So the wrong people showed up. So there's a few best way to do that is to try to qualify your leads in a better way. That might be to be very explicit about what you're selling, who your ideal customer looks like. Your website or your message, whatever you have, should be very clear about this is the customer we're selling to, this is the value, this is what it looks like. The customer should be able to recognize their own context, their own problem, their own situation on your website, and then they can opt into that. If they don't see it there, then they won't stick around. Zooming out from that, in terms of how to drive recurring leads and get the right level of people, it's again finding out which of those sales or marketing channels are most likely going to intersect with where your customers are. If paid search is the right option for you, I would say, are your customers more likely to be found on Instagram or LinkedIn or Facebook or something different? They tend not to overlap. They're quite distinct audiences, different interests, different purposes. There might be one of those that's more suited. And the benefit of each of those is you can really fine grain the filtering to find your audience, assuming that they exist on those platforms. So you can have quite a set of paid options to bring the customers that match what you're looking for to your website. That typically takes a lot of trial and error, but if you can get it right, that can be quite predictable in recurring leads. The other way would be to drive demand. So it could be newsletters, podcasts, email, SEO content, where you are writing the content that your target customers care about. And the more tailored and nuanced and specific you can be in your material, in the interviews you do, the webinars, the content, the newsletters, the more likely that the people you are serving will show up and will tell others about it. So finding one of these channels that fits your particular category, fits your particular product or service is where the challenge has to come. So figure out where are your customers, and then how do you get in front of them? And do you want to do that with paid or unpaid source?
Noted. Thank you so much for the answer.
Sure thing.
Perfect. Thank you, Yukta. All right, perfect. So coming down here, we've got a few minutes left. Any other immediate questions for Kevin? Or even also too, I'd love to actually, Kevin, if you don't mind, do you mind pulling up that one slide for that template? So basically the ICP, because actually I'd really would love to kind of get some thoughts from someone on this as an example, because I think everyone here, again, whether you're selling, your own mindset as a subject matter expert or a product or a B2C platform, whatever it is, I think this is one exercise that even for Gildre that, 2.5 years ago, we've kind of evolved with. And so, Kevin, I'd love to just kind of hear your thoughts I know you worked with a variety of med tech to some of the other examples you gave. Would you be able to kind of share maybe an example of something that, I guess I'm trying to think of the right way to word this, where a lot of times our ICP is not, I think you said that first kind of stage customer. And so how does this template really evolve from that kind of first stage as you get to the adjacent customer, then to the ICP? Like, how do we have to adjust this as founders throughout that process? Or do we always keep the same one because our ICP stays the same?
Yeah, so I'll refer back to the example I gave earlier to illustrate it. So the medical example where your ICP might be a large hospital. To begin with, your statement here would be, our ideal customer is a sole medical practitioner at an individual practice, struggling with patient record documentation and willing to pay $200 a month to solve that problem. Okay. And then if you think about the same statement but transitioned up for the adjacent or the hospital, eventually that might be, our ideal customer is a large municipal hospital, is the procurement officer at a large municipal hospital struggling with centralized healthcare records and willing to pay let's say $100 per person per month to solve this. So being able to scale both the scope of the problem, but also the persona and where they exist.
Perfect. Thank you for that. And yeah, everyone, the presentation will also be shared out along with the recording. So that way you'll be able to kind of reference the slides and go practice this exercise with your own value prop. So amazing. Any other final questions for Kevin? All right. Well, again, everyone, thank you for hopping on. Kevin, thank you again, obviously, for your time. And your LinkedIn is available. If anyone has questions, feel free to connect with Kevin on LinkedIn. Kevin's also in Slack. But Kevin, again, if there's anything else, we appreciate it. And your expertise is always welcome.
Thanks so much, everybody. Great to connect with you today.
Thank you. Cheers,
Take care,
everybody. We'll look out for our next workshop, June 26th, 27th, sometime end of month next month. It's going to be with Alex Bean. He had a $2.5 billion exit with Divvy. Similar format to this, you'll get a 20-minute direct interaction with him with an amazing, fantastic presentation. So be on the lookout for that, and we have a lot more events coming up.
Awesome. All right. Sure. Sounds good. Everyone soon.
Awesome. Thank you.
Bye-bye.
Take care. All.